The JP Morgan Equity Premium ETF, otherwise known as JEPI, has been a hot topic in the dividend community. This could be a solid income-producing investment, but for others with a 5 to 10 plus year time horizon, this could be an investment that lags, all due to the way JEPI is set up. JEPI pays a high distribution yield of over 11%, and this is exactly what yields both new and old investors to an investment like JEPI. And in volatile times and uncertainty in the near term, JEPI can be a great investment. Long term though, the upside is limited, all due to the structure of JEPI. They use derivatives via ELNs and selling covered calls to generate premiums in order to pay a higher distribution yield. What does this mean in plain English, you might ask? Well, when you're selling covered calls and the stock market starts moving higher, your upside is limited. It is capped to the strike price you are selling these options. Let's do an example here. So let's say you have stock A. You own 100 shares of stock A, which currently trades at $100. You can sell a call option at $105. But if stock A goes to $110, your money or your gain is capped at the strike price. So you'll be capped at $105, which was the strike price you sold that option. JEPI doesn't just sell these ELNs or sell call options, they also own actual positions as well. Let's take a look at their top 10 dividend holdings. Those top 10 dividend holdings include AbbVie, which is a favorite of mine, Progressive, the Hershey Company, MasterCard, PepsiCo, the Coca-Cola Company, Microsoft Corporation, Texas Instruments, Visa, and UPS. The largest sector weighting is financials with a 13.5% weighting, followed by healthcare, industrial, and information technology. In addition to owning these dividend stocks we just went over, and we mentioned the ELNs or selling the call options, mostly around the S&P 500, the upside is limited, and that's why an investment like JEPI will lag over the long term. As such, in today's video, we are going to look at 3 dividend ETFs that I would much rather own over JEPI. Now, this doesn't have to say that you need to own either these 3 or JEPI. You could do a mix of both. Remember, everyone has their own strategy. So with that being said, let's get into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so do not take this as financial advice, and please perform your own due diligence before investing in any stock or ETF mentioned in this video. And before we begin, let me take a quick moment to thank today's sponsor, Moomoo. Moomoo has a ton of great tools and resources for investors of all levels, dividend investor or not. What's even more exciting is that Moomoo is currently hosting a paper trading competition, offering a chance to win $1,500 cash and receive 1 month of Benzinga Pro for free. Additionally, new users who open an account and deposit in Moomoo can receive up to 15 free stocks. Just click the link down in the description below for more information. Now, with that being said, here are 3 dividend ETFs for you to consider for your portfolio. And how can we go over dividend ETFs without starting with the favorite? And that is SCHD, which is the Charles Schwab US Dividend ETF. This has become a favorite among dividend investors, and I know it is a favorite of mine and a top holding of mine. I consider it an investor's trifecta. It really checks off a lot of the boxes. You have share price appreciation, you have a strong dividend yield, and you have strong dividend growth. And one of the best things also, it's a low-cost fund with an expense ratio of 0.06%. In terms of positions, SCHD has 104 total positions, and the top 10 positions make up 41.5% of the entire fund. Let's take a look at those top 10 positions right now. Those include AbbVie, PepsiCo, Merck & Company, Verizon Communications, the Coca-Cola Company, Chevron, Amgen, Pfizer, UPS, and Cisco Systems. The top 3 sectors include industrials, healthcare, and financials, which combine to make up nearly 50% of the entire fund. In terms of the dividend, SCHD currently yields a dividend of 3.6%. Which is a nice yield, but what I love about SCHD is their dividend growth. Over the past 5 years, the fund has increased the dividend at an average annual rate of 15.6%. The second dividend ETF on our list is DGRO, which is the iShares Core Dividend ETF. And if you have watched any of my past videos, then you know that I love dividend growth. We just looked at SCHD, which is a very well-rounded ETF. They focus in on high-yield dividends. They focus on low-yield dividends. They focus on dividend growth stocks as well, a whole multitude of different. DGRO, on the other hand, is focusing primarily on stocks that can increase their dividend each and every year. DGRO is also a low-cost fund with an expense ratio of just 0.08%. Over the past 5 years, DGRO has gone toe-to-toe with the S&P 500, returning nearly 70% in total return over that period. DGRO has a lot more holdings than SCHD, more than 4 times as many in fact, as they have nearly 450 total positions. Let's take a look at the top 10 positions, which make up 26.7% of the entire fund. And those top 10 positions include Microsoft, Johnson & Johnson, ExxonMobil, Apple, AbbVie, Chevron, JP Morgan, Pfizer, Procter & Gamble, and Home Depot. The top 3 sectors include healthcare, financials, and technology, which combine to make up roughly 55% of the entire fund. As you can see, looking at that top 10 list right there, if you're familiar with those stocks, then you could see that at least half of them I would consider a dividend growth stock. And what I consider a dividend growth stock is a company that is increasing its dividend over a 5-year period at least at an average annual rate of at least 10%. Let's next take a look at the dividend stats. DGRO currently has a dividend yield of 2.4%. In terms of dividend growth over the past 12 months, DGRO has increased its dividend by 12.3%, which is phenomenal. Over the past 5 years, though, it's a little bit lower at 10.3%. Pretty solid nonetheless. And they have 8 consecutive years of dividend growth. Dividend growth keeps your dividend snowball growing. The third dividend ETF on our list is HDV, which is the iShares Core High Dividend ETF. We looked at SCHD, which is our well-rounded, broad-based dividend ETF. We looked at DGRO, which is more focused on dividend growth, and now HDV, which is more focused on higher yield dividend stocks. Usually, higher yield stocks or ETFs also come with lower volatility. That isn't always the case, but that could bode really well in today's market. It also comes without the fees. It has a low expense ratio of just 0.08%. In terms of holdings, HDV is pretty small with only 81 total positions. The top 10 total positions make up 53%, which makes sense given how few positions the fund has. Those top 10 positions are as follows: ExxonMobil, Johnson & Johnson, Verizon Communications, AbbVie, Chevron, Pfizer, Broadcom, Coca-Cola, Cisco Systems, and IBM. The top 3 sectors include healthcare, energy, and technology, which make up more than 65% of the entire fund. So as you could probably already tell based on the name, HDV has a nice high yield of 3.82%. If you annualize the latest quarterly dividend, the yield is actually 4% on the dot. Higher yield usually doesn't have strong dividend growth, but that is what makes SCHD, the first ETF that we looked at, so unique. HDV, though, is a more traditional ETF with a 5-year dividend growth rate of 5.7%. They give you a little bit higher yield, but they don't have as much dividend growth. But the dividend growth over the past 12 months is rather high at 17%. So there we just looked at 3 great ETFs, 3 great ETFs that I love and 3 ETFs that I own. SCHD is a well-rounded ETF. They have high yield dividend stocks, low yield dividend stocks, dividend growth stocks. We looked at DGRO, which focuses primarily on the dividend growth component, stocks that are growing their dividends at a fast pace, and just companies that are increasing their dividend on a consistent basis. And then if you're looking for a little bit higher yield, then there's HDV, which is the high yield dividend ETF. Down in the comments section below, let me know which of these 3 dividend ETFs do you prefer for your portfolio. And also, if you haven't done so yet, make sure you smash that like button down below and give us a thumbs up, as we truly appreciate it, and we'll see you in the next video. Take care.